Hello friends, how are you doing? I hope you're doing well, and I have another video, and it's actually looking at liquidity inducement, especially around the London Open or the New York Open. I have noticed this kind of inducement happening generally in either the London session or the New York session, because we are made to understand that there are so many opportunities when you are looking at the London session, especially the London Open and the New York Open, which basically are the kill zones according to ICT. What you can see on the screen is that we are on, for example, in an uptrend, and price started ranging. Possibly this could be the Asian range, and then we have this move creating a liquidity grab, and then we have this very emphatic breakout structure to the downside. This could well be a very nice order block, whether it is made up of one single candle or series of candles, most times depending on the time frame that you are viewing your chart. Then we have this very bearish move, breakout structure, and possibly there could be an imbalance created, which will give you more reason for price to want to return to mitigate this order block. And so we might become too excited, having seen a very good trade setup, and we quickly want to place a sell, forgetting that we have a significant low, which is the higher low that is not violated yet. And what it means is that the market is still heavily in an uptrend, so it is not wise for you to start selling when the market is still in an uptrend. You can do it, but it's very, very risky, except you know exactly what you are doing. So it's one kind of inducement. For those who want to sell, they may forget possibly there could also be a demand zone here that could take price up to continue the bearish move. This is also the same concept, but in the bearish sense of the issue. Okay, the bearish sense. You can see that once we have this top on and this breakout structure, we might become very excited to place a buy, forgetting that this market is still heavily in a downtrend. So we need to be very careful. The market can do whatever it wants to do, even if we are 100% careful. Okay, but we need to stack probabilities on our side in order for us to be safe. Okay, like in the next slide, this is what we really want to see. You want to see a change of character. Now you see that this market is in a downtrend, okay, and now we have a breakout structure. All right, we have a breakout structure, sorry, a change of character, which is actually another kind of breakout structure, but in this case is changing the market structure. There's a shift in market structure. Okay, now there's a shift in market structure from the downtrend to an uptrend. Okay, from the bearish market to a bullish market. when you notice this shift in market structure or this change of character, then for me, I'll be more confident to look for this kind of opportunity either in the London kill zone or in the New York kill zone or New York session, as the case may be. So if I notice that price has already changed character, then if I see this opportunity, I'll be more confident to take the trade. So this is exactly what this video is all about, nothing more than that. That's the liquidity I'm trying to draw our attention to, that I've witnessed recently in the market. Now we move on to the re-chart scenario, where we're looking at Euro USD, Euro dollar. We are on the weekly chart, as you can see. Okay, now what's the essence of this chart? Why am I bringing it in? Just for general knowledge. For example, we want to be able to predict where the market will be going. Let's assume that we don't have this candle. Okay, let's assume that we don't have this candle for now. This particular candle, let's assume we don't have it. So you can see that the concept I'm going to be using here is the concept of 3 candles description of swing highs and swing lows. Okay, and what do we really mean by a swing high based on the 3 candles description? When you have 3 candles this way and the one in the middle is higher than the one on the right and on the left, the high, or the highs of the first and the third candle is lower than the high of the middle candle, then we say we have a swing high. And if the low of the second candle is lower than both the lows of the first and the second candle, first and the third candle, sorry about that, we say that we have a swing low. Now what's the significance of this? It's kind of very useful in determining the direction of the market, especially where we have a continuation trade. For example, if a swing high is broken, if a swing high, sorry about that, I'm so sorry about that. If a swing high is broken, for instance, we have this swing high is broken or around this area, and then price decides to form a swing low this way. Okay, price decided to form a swing low that is actually higher than this. If price forms a swing low, what we expect to see is that most likely the next candle that will be formed is going to be bullish. This is the more aggressive approach of it. The less aggressive approach is to wait for this fourth candle to form. If the fourth candle trades above the third candle's high, then we expect that the fifth candle is going to be bullish, and possibly subsequent candles will be bullish. So that's the whole idea of what I just want to highlight here. So for instance, you can notice that this is actually a swing low. We have a swing low here, and let's say that the swing low is broken. Sorry, let me have a better diagram. We say the swing low is broken here. Okay, so after the break of a swing low, what we need to look for is a swing high. As you can see, we have this swing high here defined by this candle 1, 2 and 3, and once we have a bearish candle trading below the third candle, then we can expect that this is going to be a bearish candle. This is one way we can actually find direction in the market. Okay, talking about this case, we also have this swing low being broken, and then we have a swing high form by this candle, first, second and third candle, and you can see that the third candle is traded through, and based on what we said, we can also predict that this candle is going to be bearish, and exactly what happened. Subsequent ones will be bearish. So with this, you can tell that the weekly candle is going to be a candle with a bearish close, and in that case you can predict that the week is going to be bearish, and you can start looking for, if you're a day trader just like I admire to be, you can start looking for majority of the times bearish days within the week. So that's what we are trying to say here. Oh, okay, sorry about that. Alright, so that's really what we want to say. If we move on to the next slide, before then we can see more reasons why this candle may likely be bearish, because there's a weekly imbalance here that we expect price to take out. Okay, and this video, I prefer this video for a very long time. I mean the diagrams for a very long time, and you can imagine that as I speak to you now, this market actually went down, even break this imbalance. So wonderful. It can be wonderful. The question is, did I take a trade? It's another thing. So now the next slide is going to be showing us some annotation. The weekly imbalance field, this is a very possible target for this week, and eventually it actually meets the target very well. It was a very good bearish week. Okay, and from there we move on to the daily chart. And on the daily chart, all we just want to do is also to notice that the daily is quite bullish. It's bearish, as you can see, and this is a weekly imbalance from the weekly time frame. Is a weekly imbalance. So we have, I don't know, this could be maybe the third day. You can see that they are actually bullish, very bullish week that we are having. If I have time, I would have been able to check. Okay, so that's what we have. The next slide, we are looking at the 4-hour chart, and in the 4-hour chart we can see some internal order flow here. Price makes higher high, higher low, higher high, and what? A change of character, breaking this higher low. Okay, by the time I have this change of character, then I am more confident to take sell positions. Okay, more confident to take sell positions because I already have this internal order flow change of character. We are going to see that more clearly on the daily charts, sorry, on the 1-hour chart. So this is what we are talking about: high, low, high change of character, and we have this 4-hour order block. If you move back to the 4-hour, you will see this 4-hour order block, which was actually a single bullish candle, but coming down to the 1-hour time frame is 4 bullish 1-hour candles, and this is what makes up the order block. And you can see our price actually went tapped into the order block and then sold from there. I know majority of us may not like to, sell like this with this stop loss range. I know majority of us wouldn't want it, or want a smaller range. Okay, that's where you call for confirmation entry. You scale down to the lower time frame, and as you can see, after this change of character, the next thing we start to look for is a change of character of this move as well. Okay, so we have this high, low, higher high, higher low, higher high, higher low, higher high, higher low. Of course, we did not have, what we have here was a shift in market structure, and we have this change of character. This may not be the best probability that I would like to take or consider. I would have loved to see something like this, and price just like this, okay, and price doing this. Then I'll look for opportunity to take the price down. But what price did was just like this. We have something like this. We have a shift in market structure, and of course it's equally good. And most times this is supposed to be the strong high, but now you can see that it was used as liquidity. In this case, it was used as liquidity inducement. Okay, so price went up, tap into that point before coming down. So let's move lower to possibly the 50 minutes time frame. So we are on 50 minutes time frame. You can see what happened. Already I know that the market has shifted from the bullish to the bearish market, so I'll start looking for opportunities for me to go short. And even this market that was bearish has also shifted to the bullish, has also shifted to the bearish market. So I will start looking for opportunities to go short, and this is where we have a very nice opportunity to go short, which we are going to see on the next slide. Where is it taking place? That is where time and price comes in. Where is this opportunity taking place? This is exactly what we are looking at. Where is this opportunity taking place? As you can see, this is also a stop point and a break of the structure, and price decay. Just watch this carefully as well. Stop on break, and that is exactly why this was used as a liquidity inducement. Okay, because we actually have an order block there. We actually have an order block here. This order block, this could be a liquidity inducement in that case, even though it has broken structure or maybe change of character. But my main focus is this area. Okay, this area, that's my main focus. Now why am I focusing on that area really? As you can see, this is the Asian range or Asian session, and you see this price clearing this liquidity above the Asian high, and then we have a bullish move down, breaking the structure, and then we expect what? Price to mitigate, and then we take out. So this is a very good opportunity for us to most likely this will not be induced as when the market has not shifted to a downtrend. Okay, so if we move on to the 5 minutes time frame, you will see exactly what I'm talking about. Let me just show us this one very clearly. So you can see this other block stopping. This is the London Q zone. This green, light green shaded area is the London Q zone, and you can see that price is clearing the liquidities above the Asian range, and we have this very convincing move downwards, and we even have what an LPG, an imbalance here. So most likely there are very strong reasons why price may want to go, and if he asks me if I want to be very, very safe, I am going to place my entry here, just here. Okay, sorry. Very sorry about that. So I'm going to place my entry just here, and it can be very risky if you place your stop loss above, but preferably above this point. Okay, yeah, this trade, sincerely, I'm not a good trader, but I can tell you for sure that I entered this trade. But you know what? This is where this is my entry, my stop a little above this point, and I took profit here. It's not real. It's painful, and I took profit, but it's okay. But that's a fact. I took a trade, but this is where I got out of the trade. Probably still trying to build some confidence, but the main point is there can be some kind of liquidity inducement that we should be really aware of. Always wait for change of character. It's going to make you safe. So this is what we're saying. We have a broke of structure here, and majority of us can say, wow, this is an order block clearing the liquidity below the lows and breaking structure, and even with a nice imbalance. Some persons can decide to take their trades, enter here, put their stop loss below here, and you can see what price did. Price came, cleared the stop loss. This is a liquidity inducement. This is inducing buying, and you can see what's happened. This market continued to go down, so everyone who wanted to buy, they're surely going to suffer for it. So this is the main point of what I'm trying to teach, and I do believe that you've gotten some value. You can see what is happening. The market break It's a change of character from up to down. Now the market is in a downtrend, and what are you doing? You want to buy when your market is in a downtrend. So what am I saying? Is there a way for you to always escape liquidity inducement? No. Is there a way for you to trade without losing? No. But what I'm saying is you can reduce your losses when you understand market structure. You understand market structure, and you are always very careful to know that you are on the right side of market structure. It's really going to help you a lot. Okay, that's the whole essence of this particular video. Okay, yeah, so thank you for your time, and please like and subscribe if you find any of the content useful. God bless.